Good afternoon, everyone, and welcome to the 5th webinar of our 2014 series, Insurance by the Numbers, where we're focusing on a different number each month from 0 through 10 and how those numbers impact your clients in the insurance world. This month, we focus on the number 4, with 4 things that make individual insurance more attractive than group insurance for long-term care insurance, disability insurance, and life insurance. The presentation today will last between 50 and 60 minutes. And you must be logged on for at least 50 minutes from the email address you registered with to qualify for CFPCE credits. And unfortunately, your attendance data cannot be captured if you're logged in on a tablet. If you have questions as we go along today, feel free to ask them on screen, and we'll do our best to answer them timely and without referencing names. This webinar is being recorded and will be posted to our website within a week. Your presenter today is Mark Maurer, Low-Load's President and CEO. And in keeping with the acronyms, he's a CFP and an MBA. He's a member of the National Association of Insurance and Financial Advisors and a frequent speaker for, more acronyms, NAPFA, ACP, Garrett Planning Network, and other organizations seeking insurance-related education. Now that our housekeeping notes are done, let's get started. Here's Mark.
Thanks, Dina. That was A-OK. I am your MC, so let's get started. What we're going to cover today are some comparisons between group insurance and the options available and individual insurance. We're going to touch on the differences in group term and individual term, group long-term care insurance and individual, and group disability insurance and individual plans. So for term life insurance, there's a few things that separate the traditional group term policies and individual term plans. With individual term policies, you have there are multiple underwriting classes available, and I'm going to show you how that impacts what your client ultimately will pay for the coverage. The individual term plan has guaranteed level rates, and traditional group term plans don't, and I'm going to look at that a little bit. Most level term policies are convertible for the full term period, and we're going to see what options your client may have with their group term if they decide to leave their employer, as well as being portable. Individual term policies your client owns. It's based on him or her alone, not tied to their employer. So for employee-paid group supplemental life, there's a lot of words there. Many employers will provide the first $50,000 of life insurance free, and the IRS says nobody pays taxes on that, nobody takes it as income. It's great. It's free, it's free, it's great. And then an employer might pay for an additional one-time salary. The employer pays for it, and your client recognizes the payment or the premiums on their tax returns, but they're only paying taxes on the premium, not paying the premiums. Those are all fine and dandy. They're good. Free is good, and paying taxes on it instead of paying for it is good too. But anytime your client starts paying for it out of pocket, they need to talk to you. You need to talk to somebody to make sure that it's a good comparison and it's the most efficient thing for your client. Because the group supplemental employee paid coverage generally is guaranteed or simplified issued. Meaning there's no underwriting at all, or maybe 3 or 4 underwriting questions. Of course, if your client is in poor health, or at least poorer than average health, it might be great if they can get a guaranteed issue with no questions asked. For some people, it may be the only way they can get some life insurance, so that's great. Generally, there's a male and female rate and a smoker-non-smoker rate. With individual life insurance, your client has to do an application. They have to have a paramed exam where they take a blood and urine sample. An insurance company is going to review their medical records. So there's a lot more things going into it, but there's a lot more things coming out of it in the form of multiple underwriting classes. And that's how we can have a super preferred plus or a preferred elite rate class, a preferred, a standard plus, a standard, or a table 2, the gamut of underwriting classes that insurance companies can charge based on a client's particulars, rather than saying, okay, if we're going to cover everybody, we just need to charge this one rate. group term for your very young clients it's very low premium, and it may be hard to get your clients to have the long-term horizon thinking that makes them realize that they may pay more today for a level term than a group term that increases every few years. But when they're 30, the group term is very inexpensive because they're 30. The chances of something happening to that particular client are very low. With the group supplemental life, the rates increase every 5 years. So as your client moves from age 44 to 45, their rates are going to go up. 49 to 50, quinquennial age, which is the fancy word for every 5 years. With an individual policy, the guaranteed level period is exactly that. If I want this premium guaranteed for the next 20 years, this is exactly what I'm going to pay for the next 20 years. I touched on this, that the employer might provide one-time salary. When we have the guaranteed or simplified issue, your clients may not be able to buy 15, 20 times salary, or the total amount of insurance you might like them to have might be capped at 2 or 3 times. And so they may not even with the group supplemental life, they may not be able to get the amount of coverage that they actually need. And with the individual standalone policies, they can get as much as they need, want, qualify for. The group coverage, is it convertible? Maybe. It's not always. But if it is, there's generally one conversion policy. And even then, it probably isn't that competitive because I didn't, if I'm an insurance company and I offered the group coverage, I didn't ask any health questions to begin with, but I assumed that while you're working, you're still healthy enough to work. If you're working, you're alive, basically. But once you're not working, then I really don't know how you're doing, and so I may not give the best options once you're no longer employed, and so it may not be that competitive. With an individual policy, those term policies are convertible for however long it's specified in the contract, to age 70, to the end of the term period. And if I was issued a preferred rate on my term policy, I can convert to a preferred policy later. Most, and I would say 99.9% of the time, group supplemental life isn't portable as group insurance. So there's a difference between convertibility and portability. Convertibility says if I want to keep the insurance, I have to convert it to whole life. I can't keep it as group term. Very rarely have I seen an employer that provides a group plan that a client can then just keep on as group term. And of course, individual term, it's term. It doesn't change because that's what it is. So when we look at pricing for a male for $250,000 of the group supplemental employee paid coverage and what he'd pay for the same $250,000 of a level term period, and let's compare, let's say, to age 65. We still think of that as most people's retirement age. And so your client is 40. He's in this 40-year-old, 40 to 44, it's hard to say, bracket. And for the group coverage, he starts off paying $255 a year. And that looks good. And we get the client gets a quote. He gets a 25-year term policy that covers him for the next 25 years to age 65. And the premium is a higher $312 to, say, $379 at a preferred or preferred plus rate class. So compared to the group, that looks kind of high. But what we may not, and this is where that long-term outlook comes into play, is that yes, a client may pay $255 for the next few years, but then when he turns 55, the premium goes up to $430. Had he locked it in at age 40, he'd still be paying $312. When he turns 50, 10 years later, it's $630 for the next 5 years. So while it's maybe lower today or in the short term, long term, it's really not going to be. So this is sort of a comparison I put together. What is the real cost of that group term? Well, even though we had the comparison, had the discussion about the 25-year level term, he said, you know what, the group term's great, it's lower, it's less by about $90 a year, so I'm going to go ahead and sign up for that. And unlike a lot of people, I think the statistic is most people change jobs 7 times in their working career. He's 40 and he stays with the exact same employer for the next 25 years, and the employer doesn't make any changes to that group term plan. It works exactly like it was illustrated. So over the next 25 years, he will have paid over $21,000 in insurance premiums because of those increasing bands. So every 5 years, he pays a higher rate for the next 5 years. 5 years after that, a new rate for the next 5 years. Had he signed up for the level term for $365, more today, less pretty much for the last 20 years, he would have paid just over $9,000 for the same death benefit. So that's about 43% of the group rates. Again, this is sort of short-term and long-term trade-offs. In the short term, the group term looks competitive, but need to get that information on what do we expect the premiums to be over the long term, and how does that compare to the individual policy. So that was at age 40. The group term looked competitive. Well, now your client's age 45. He gets that his paycheck went down a little bit more than he thought it was going to, and says, I wonder what's going on here. Looks at the pay stub. Oh, my life insurance premiums went up. Okay. Well, he comes back and says, Mr. or Mrs. Advisor, we looked at this a while ago, and the group term was a better deal. But I saw this go up by a couple $100 a year, so let's relook at it. So my group term is now going to be $430 a year. If he applies for the same amount for the next 20 years, so a 20-year level term, 45 plus 20 gets him to age 65. If he's a preferred plus, annual premium is $339. If he's preferred, just under $400. So at age 45, our sort of break-even health class, if you will, is if I'm in better than average health, then I can lock in a lower rate today. And that's locking in a lower rate today and for the next 15 years too. Even if I locked in a select rate, yes, maybe paying about $50 more for the next 5 years, but then still less for the next 15 years. But your client, he's 45, he says, this seems like a lot of work. I'm going to go ahead and keep the group term for another couple years. Okay, at age 50, we do the same thing again. He calls you and says, you know what, my paycheck went down again. Well, now my annual premium is $630. And if we compare to a health class, if he's a preferred plus, preferred, or select, a lot of companies call that a standard plus, he can save money today by taking a new $250,000 15-year term, 15 plus 50, age 65. And so as long as he's in better than average health, then a new policy actually costs him less today and for the length of the term. One more time. He's 55. Wow. I remembered when that premium was $630 like that, but it went up to over $1,000. Okay, I really need to look at this time. So notice what keeps happening. As the clients get older, the insurance companies are pricing, assuming all the things that really do happen in life. As we get older, we tend to get a little heavier. We tend to have high blood pressure, all these things that tend to happen. So as the insurance company has that group term and they're repricing based on people's older ages, they're factoring that in. With the individual term, if you're a super preferred 20 years ago, that rate's locked in. And so what you can see here is at age 55, even if he's standard. So all the 4 non-smoker rate classes before a table rating or a substandard rate class saves a couple $100 a year by going with an individual term policy. Well, Dick Van Patten at one point in time said, yep, 8 is enough. But is that true with the group life insurance? Well, John and Kate thought that 8 was enough. John and Kate plus 8, they thought it was enough. But it ended up not being enough to save their marriage. So your clients are going to ask the same thing about their group supplemental life insurance. Is it enough? And generally, the answer is no. Group may only offer an additional 2 to 5 times income. I'd say 5 times is usually the maximum that I see. And then for non-employee spouses, it can be a very small amount, not more than 50% of what the employee spouse has, or maybe just $20,000 to $50,000. So for most of your clients in the age 40, 45, almost everybody, 2 to 5 times income isn't going to be enough. So how much can a client get through an individual policy? Rule of thumb, ballpark numbers, back of the envelope. When your clients are in age 20 to 30, most insurance companies will consider up to 30 times income as a reasonable amount of life insurance for income replacement. And as you can see, as the clients get older and get closer to retirement, they have less years to retirement, so the multiples of income decrease. Again, probably not too surprising. So this is again, a ballpark of most insurance companies, financial plans, lots of things. If your client's 40, 2 to 5 times income if something happened to a working spouse, 2 to 5 times income, they need more than that. And so the individual term plans factor into getting your client the actual amount that they need. What about a non-working spouse? And I need to change this to put something more like non-employed spouse, because I know my wife works much harder than I do. I get to sit down at an office most of the day, so I actually get to sit down. I get to eat lunch by myself uninterrupted for a few minutes. I digress. So for the non-employed spouse, most insurance companies will consider the matching coverage on the employed spouse for up to about $1 million. So if the employed spouse has $1 million in life insurance, then the unemployed spouse can get up to $1 million. That's also generally an individual coverage as well. And then over and above the $1 million, maybe an extra 50 cents on the dollar on the coverage of the working spouse. So if the employed spouse has $2 million in coverage, non-employed spouse may be eligible up to 1.5. Those again are sort of like the other numbers, round numbers, 20 times income, 30 times income. But more is available if we can outline the need in excess of these limits with help from you. When we get into situations where we have special needs children, or things where if one spouse isn't alive, there are not just the normal costs of child rearing, but lots of additional costs, specialists, things like that. But at the end of the day, ask yourself, is it reasonable? Like most things in life, if you ask yourself, is it reasonable, then that's probably a good answer. So let's take Mary. Let's look at Mary. Mary makes $60,000 a year as a consultant. The husband makes $120,000 per year, but he's only insured for $200,000. So right away we see that he doesn't have very much, less than 2 times his earnings. Can she be approved for $2 million in life insurance? And since it sounds like a trick question, if you all are paying attention, then you'll say, yes, I'm pretty sure she can. Otherwise, why would Mark have worked that into a slide? And of course, you'd be right. The answer is yes. Here's where the extenuating circumstances come in. Her net worth was over $2 million, but it was all in a family trust, meaning her family. So they were using the money in that family trust to supplement their income, their lifestyle, their house, etc. But if she died, the money in the trust did not go to the husband. It did not go to the children. It went back to her other siblings, her brothers and sisters. So while the $2 million is definitely more than 20 times earnings for her, it's more than we would say is maybe reasonable based on how much he has, because there was so much, this big additional money that would definitely not go to anyone else in the family. We were able to get underwriters to to agree, yes, the $2 million number seems reasonable. So we asked, will it be enough? And with individual coverage, we can make it enough. Will it be there? That's another question. Well, if your client leaves employment, they may have no option to keep the group term employer supplemental coverage. But usually they have an option to convert to a permanent policy. Now remember, like I said before, there was normally little to no underwriting when they got the group term. So if the conversion is not going to use a super preferred pricing. If I have to assume some sort of average health rate for the group term, and then I may or may not want to price it so it's efficient for people to convert the group term, because I didn't ask health questions as an insurance company. So I'm going to touch on that in a minute and show you a real example. And many times they may not be able to take all of it with them. Sometimes the policies that your client convert to may be 100% of what they had when they leave, and then at age 65 or 70 may reduce, but the premiums stay the same. So that's all in the fine print, but generally there's going to be a thing. With the individually owned coverage, your client owns it no matter what job he or she has. They just own it. The premiums are guaranteed for the specified period, the 20 years, the 30 years. If they decide to keep the policy after the end of the term period, through the end of the conversion period, they can convert that term policy to permanent coverage with no medical underwriting based on the underwriting class that the term was issued at. So if they were issued at a super preferred rate class on the term, they can convert the permanent coverage to a super preferred rate class. So we had one advisor's client who was 53. She was changing jobs and had 1 week to decide if she wanted to convert her $336,000 Unum group life insurance that from her previous employer while she was in the process and getting new coverage and being eligible for the other group coverage from the new employer. So what the employer had sent her was a table of rates, and if you want to keep the policy past your retirement date or date you left employment, then the annual premium was going to be $32.08 per $1,000 of coverage. And you think, okay, I guess that doesn't sound too bad. What does that translate to? It translated to just under $10,900 per year. And I put in with a $90 policy fee because if you did $32.08 times 336, it would be slightly off. So there was a $90 policy fee in there, but just under $10,900. $10,900 was her cost to convert that group term to permanent coverage as a form of whole life. So that was our starting place. She wanted $336,000 of 15-year term. She was 53. That gets her to age 68. Anywhere from $450 to $880 per year based on her underwriting class, from a super preferred to a standard non-smoker rate class. So $880 to $11,000 a year. Again, may not be necessarily that hard of a choice. But what if you, not necessarily comparing apples to apples, so how do we compare the conversion whole life to a standalone permanent policy? For $336,000 of a no-lapse guarantee UL policy, anywhere from $2,700 to, let's call it $4,000 per year. So that's the cost of the conversion, is that difference between the $10,900 and $3,900 per year. Now, if all she really needed was term for some income replacement, great idea to do that. In this actual example, the client was going to convert the policy, pay monthly for 2 or 3 months while the new policy was going through underwriting, just so there wasn't a gap in coverage. But then her goal was to cancel the group conversion as soon as the new policy was in force. So that's what we touched on term insurance, looking at the different options from from group to individual coverage. The next thing I'm going to touch on is long-term care insurance. With, again, group long-term care insurance generally has one underwriting class. With individual long-term care policies, there may be multiple underwriting classes. There may be a number of different discounts for spouses, partners applying together. Individual long-term care plans can't be discontinued. I have seen employers where they decide to stop offering or subsidizing a group long-term care policy. And the options are generally somewhat limited in a group plan. So that group plan, one underwriting class. Now this can be good if your client is able to purchase it on a guaranteed issue basis, has health issues, so that can be a plus. If your client's in better than average health, though, it may be a plus to apply for an individual policy. Recently, a number of companies a few years ago just had a sort of a standard, had a preferred and standard, maybe just a standard. Today there are companies that have even a preferred plus rate class on their long-term care policies. So for clients in better than average health, the individual plans may be the way to go. Group plans tend to come with a group or multi-policy discount. Surprise, surprise, no group discount when it's not group. But group plans also tend to have no couples discount. I don't know that I've ever seen one that does. And with individual policies, there can be anywhere from a 20 to 35% discount per person for spouses or partners who apply together. Some companies have a smaller discount if there's a spouse or a partner but only one person applies. So big discounts for couples on individual plans. And I touched on this. The group plans can be discontinued. The employer can choose to stop offering that as an employee benefit. With individual plans, long-term care policies are guaranteed renewable, meaning that except for non-payment of premiums, the insurance company has to renew the policy every year. They can raise rates, but they can't cancel the policy, can't make any changes to the policy benefits. And with the group plan, there tend to be some limited options. With an individual policy, there's a full selection of options. So let's look at the options like a menu. With a group plan, generally there's sort of a small menu. And depending on where you all like to eat, this may be a big or small menu. For lunch, I think this is a fair-sized menu. But if I wanted dinner and was taking 5 or 6 people out to eat, may not be a big enough menu. So with the group plans, an example of sort of the menu would be 3 benefit options, $120, $150, or $200 daily. There's lots of, we have software programs where we can customize plans to the state of Virginia or Virginia next to DC or just in DC, and determine how much any particular client wants to insure for long-term care. Do they want to cover the home health care? Do they want to cover the assisted living? How about the daily rate for nursing home care? Those are all things we can customize within $10 or $5 depending on the company. Here we have 3 options. Not that that's bad. It helps simplify things. Usually if I go shopping for something on Amazon, I spend 2 hours because there's way too many options. Sometimes I wish there were just 3 options. And with our benefit periods, 2, 3, 4, 5. That's fairly good. Inflation options. I don't have a 3% compound. I don't have a 5% simple. I have the future purchase option, sort of the minimum, or the 5% compound option, sort of the maximum. With this group plan and with most group long-term care plans, there is a cap or a percentage of the benefits that are available for home health care or assisted living facility care, anything but nursing home, that is lower than the full daily benefit. The individual long-term care plans, I think, that are out there that most advisors would like the clients to have, the ones that we recommend, have 100% of the daily benefit available for home health care, nursing home, assisted living facility, adult daycare. all the things are covered because I think most people would like to stay in their home if possible. So that's one thing within group long-term care plans that sometimes can be a negative. Now, for this particular client, this client is in the spouse's open enrollment period, so no underwriting or medical questions are asked. And generally, there's a short window. Usually it's about 1 month, and it tends to be somewhere around November, where clients are asked to make this decision. Advisors are calling us to help with this decision. So Myrna, at age 58, and I think she should live in Smyrna, but Myrna, age 58, opted for the $150 a day benefit, 5-year benefit period, and the 5% compound inflation option. Her monthly premium was going to be $216.20. Now, if she was in better than average health, if Myrna and husband were going to apply together for long-term care, so they were going to either get the group long-term care insurance or they were going to apply for individual coverage. If they applied together and she was able to get a preferred non-smoker rate, a preferred rate instead of the standard rate, her premium was going to be $200 per month instead of the $216. So not a huge difference there, but the benefits were going to be 100% for the home health care, the daily benefit 100% available for home health care rather than just the 80%. But if she's just sort of in the standard rate class, $239 instead of $216 per month. So really the benefit there is the home health care or the lower premium. Now, as it actually happened, Myrna was in less than average health, and so the ability for her to sign up under her husband's group long-term care insurance plan was very valuable. And so that was our recommendation after we got some information about her. So the last thing I want to touch on is disability insurance. And with individual disability insurance, the benefits are income tax-free. It's non-cancelable and guaranteed renewable. There's many different riders that are available on it as compared to a group plan, and it's fully portable. And I'm going to show you why that portability makes a lot of sense. Okay. With group disability, the most common amount that a client may be covered for is 60% of their base salary. And most of the time, and I'm using generalities here, most of the time that doesn't cover any sort of bonus commission income. Usually it states something like regular monthly income. And so group is going to generally exclude any sort of bonus or commission income, and for many of your clients that can be a very large amount of their annual take-home. And so that's a detraction from group coverage for many of those clients. With individual coverage, and disability insurance companies realize that whatever you take home, you're living on, and so may be able to cover a large percent of that bonus and commission. Taxation. If your employer pays for group coverage, great. The employee's not paying for it. But what the IRS giveth, the IRS taketh away. And so if the employer pays for it, the employee doesn't take it as income or pay taxes on it. If the client receives the disability benefits, then those benefits would be considered taxable income. With individual disability plans, because your clients are paying for it with after-tax dollars, any benefits they'd receive are paid income tax-free. With a group plan, whatever the definition of disability is in the plan, it is what it is. Maybe in any occupation. May have a more generous definition for the first 2 years of the plan and then in any occupation thereafter, meaning you're disabled if you're unable to perform any occupation that you may be or eligible for or qualify for. With individual plans, we can add the more generous own occupation that allows your client to receive disability benefits even if they're back to work but can't perform their duties as a a surgeon. The elimination period, again, like the definition of disability, it's set by the plan documents, but usually 90 days, 180 days if the employer has a sort of short-term disability plan, but it's set in the plan documents. With the individual plans, we can set it from 30 days to 1 year, just depending on your client's particulars. Group plans can be terminated. It is what it is. It's not guaranteed that it will always be there. With individual plans, they most commonly are set up as guaranteed renewable and non-cancelable. So like a long-term care policy, it's guaranteed to be renewed every year except for non-payment of premiums. But with individual disability, there's also a non-cancelable. Being older policy designs, they can also guarantee what the premium is going to be to age 65. So even more guarantees for the individual plans, definitely. With group plans, generally there's only a residual or partial disability benefit available. With individual plans, you can have the residual as well as future increase options, cost of living or inflation options, catastrophic benefits. And I'm going to touch on that here just in a second. Can group plans be converted to individual disability plans? I've seen it maybe once in the last 2 or 3 years. It generally can't be the full amount converted. It may only be for a 2-year benefit period. So I would say 99.9% of the time, no. Every once in a while, yes. With the individual policy, it already is individual coverage. And with portable, with group disability insurance, is it portable? No. You can't keep your group disability once you leave employment. The only option is sometimes a conversion. With individual coverage, it's yours. It follows you wherever you go, no matter what occupation you happen to be in. So 2 big points on the group DI. It's cancelable. With your individual policy, it's not, it's non-cancelable. Premiums are guaranteed. It follows the client wherever they go, even if it's in a new occupation. And the group disability benefits are going to be taxable as income most of the time. Sometimes your clients may be able to pay the taxes on the premiums or pay for the premiums themselves, but 9 out of 10 times the group disability benefits are going to be taxable because the employer is paying for it. It's a nice benefit. And then with a supplemental individual disability benefit, then those benefits are income tax-free. With the future increase options, some of the riders that are available. The future increase option allows the client on an individual disability policy to increase their coverage based on increased earnings. Your client makes more money, they may qualify for more benefits. The future increase option allows them to increase their policy without any medical underwriting. It's in bold because that's the aha. For anyone who's gone through an individual disability application, it's long, it's invasive, there's medical underwriting, there's financial underwriting, there's a lot that goes into it. And so most people would probably really not like to do that again if they don't have to. So the future increase option allows them to do just that. Shows financial documentation and justification that they are eligible for more and can just increase that current policy. The residual benefits. Without a residual benefit, once a client returns back to work in any form, even if it's 2 hours a week, the policy generally considers that that client is no longer disabled. So the residual benefit is very valuable in that it allows payment of partial benefits if your client is not considered totally disabled, either anymore or even from the beginning, but still has a loss of income and or duties. And so it prevents the disability policy from being an all or nothing. Many claims are on residual. Many claims start off as a residual. A client isn't 100% completely and totally disabled, but has some loss. And so the residual benefit allows for a partial payment while the client is building back up. The COLA benefits, cost of living adjustment, or increases in the policy. Just depending on the language in the contract, this increases the benefits while on claim. So where future increase options allow you to increase your benefit, your monthly benefit, before you go on claim, the cost of living adjustments increase your policy after you've been on claim for 1 month or 1 year. And so that the benefits, if you're on claim for 5, 6, 20 years, the benefits continue to increase to keep up with inflation. And the catastrophic rider. There are generally, depending on the company and the particulars, there are some triggers that allow for an extra benefit. And where this is particularly valuable are significant disabilities like loss of sight, loss of speech, cognitive impairments, things where a client may not either ever be able to return to work, or even if they were, may not be able to earn anything similar to the income they were earning. So between the base benefits and additional catastrophic benefit, it's possible that your client could receive 100% of their earnings through the combination of those two benefits. And so I have one question that I will answer here in just a couple minutes about how does, if you have group disability, are you limited by the existing coverage when considering an individual policy? And I'm going to touch on that in a few slides, but yes, the insurance company, when you apply for individual coverage, will ask, what is your income, and then do you have any existing disability benefits, either individual or group? So at any point in time, an individual policy is going to supplement or lay on top of any existing benefits. Now, I touched on the whole issue of portability. Can I keep it as group DI? No. Can I convert it to an individual policy? Very rarely. So what about your client who changes careers? Well, the best time to get that policy is while they're still working at the current job, because an individual DI policy is portable. Get it now. I'll probably say this 3 or 4 times because I think this is worth repeating. Get it now, get it now, get it now. When is the best time to get supplemental disability coverage? Now, before your client changes careers. And disability insurance companies like stability more than anything. So for a client who's been an attorney for 4 years, great. There's a reasonable expectation of income. Very easy to get that person coverage generally. And there are some professions, like attorneys, who may still be eligible for coverage even when they're moving from a different employer. So think of an attorney who moves from working for a large firm to setting up their own practice. Could be a doctor, could be a CPA. Many of these professions are still eligible for coverage when moving because it's the same line of work. So as an attorney, it's probably realistic that if I'm working at a large firm and I go out on my own, that I realistically would expect to be able to earn about as much, if not more, on my own. And that's a reasonable assumption to disability insurance companies too. Sometimes there may be a cap. If I'm making $500,000 as an attorney at a large firm, may not be realistic that I could make exactly the same the first year out on my own. So many disability companies will consider a smaller amount of income. So they may base what benefits they offer on, say, 75% of a previous income. So with the assumption that starting out on your own may not be able to go right from 500,000 to 500,000, but realistically it won't be 30. I have another question for the group long-term care insurance. So the question is, how does the future purchase option work? Is this automatic? With group long-term care insurance, there's a rider, so there's the automatic compound inflation option, and that just happens automatically. You pay for it every year, and your benefits go up automatically. Future purchase option is just that. And each company works differently, but about every 3 years, your client is offered the chance to purchase an additional, and again, 5, 10, or 15% of the monthly benefit. And so they can increase it by $10, $15, or $20. And so that's offered every 3 years. If they decide to increase it, then they purchase the additional amount based on their current age. So is it automatic? It's automatically offered. Generally, if you turn it down twice in a row, it stops being offered. Over a certain age, I think maybe age 90, it's not offered anymore. If you're on claim, it's not offered. So I hope that answers that question. Back to our DI. Now, when is the best time to get supplemental disability? Now, before your client changes careers. Other profession changes may require 1 to 2 years of positive income in new occupation. And so there's a few things there. If I am an attorney and I decide to own a hot dog stand, I might need 1 or 2 years of positive income because I may be the best attorney in the world, but if my hot dogs are all moldy and my the ketchup's all rancid, I won't make much money as that. So if I'm a disability insurance company, I don't know that I'm going to consider that, expect that I'll earn $500,000 a year as a hot dog vendor. So going from a same line of occupation, there's a realistic expectation of income. A new profession change may not be, and so there needs to be 1 to 2 years of positive income. So not just 1 or 2 years in that occupation, but positive income. Because success in one occupation doesn't guarantee success and income in another. And so for the highlight of this presentation, where is it? Where have we seen that success in one occupation does not guarantee success and income in another occupation? Michael Jordan is the Jordan dynasty, the NBA's best ever. And for any of you, those who don't know, that's basketball. And a little while later on the cover of Sports Illustrated, bag at Michael Jordan and the White Sox, this is baseball, are embarrassing baseball. So success in one profession does not guarantee success and income in another. How about David Hasselhoff? At one point in time, Baywatch was the #1 watched television show, not only in the U.S., across the world. And then David Hasselhoff came up with a new singing career, and as I remember, it was very big in Germany, but besides that, not quite as successful. Madonna, singing, concerts, all of that. Movie career, didn't pan out quite as well. So, what is my summary here? Success in one occupation does not guarantee success and income in another. Your client believes that they will be, you believe that they will be, but to a disability insurance company, it's possible that they may be that best trial attorney in the world, but as a hot dog vendor, they just may not be good. So while they're in that current occupation, it's best to get the supplemental disability coverage while they're still employed, still have reasonable income, reasonable expectations of income. So get the supplemental coverage today that's available to fill the gap, and then when they move out on their new occupation, new job, they'll already have a base disability plan that's portable. One question is, will the insurance companies review the tax returns? Yes, that is part of the disability insurance application. That's why one of the reasons why I said that's one of the more invasive policies. There's the health underwriting, but there are the tax returns. And so at any period of time when you apply for coverage, generally employees just pay stubs, but for business owners, maybe additional tax records required. So Dave is 32 and makes a very good income. He makes $12,500 a month in salary and the same amount in bonus. So he's a highly bonused employee. And if you remember my last few slides, you probably know where I'm going with this. His group coverage does not cover his bonus or commission income. So automatically we know that half of his annual living is not covered by his group disability coverage. And what is covered is that he has $7,500 a month, or actually he has a 60% group coverage, but with a $5,000 a month cap. So 60% of his salary would be $7,500 a month, but his group plan caps out at $5,000 a month. So he only has $5,000 a month. What's his gap? $20,000 a month in the coverage that he's not insuring because of different options. So after tax, or not after tax, after the reduction of the 60% with the 5% cap, he has basically $5,000 a month from group disability benefits. What is he eligible for? To fill in that gap, he's eligible for just over $12,000 a month of tax-free supplemental individual disability coverage. So quite a bit. Again, this is pretty lopsided because half of his income is commission that we know is not covered, but he's eligible for over $12,000 of individual benefits that he's not receiving. Now, to put this in an after-tax basis, because on the first slide we're looking at is gross income, but then the individual disability benefits are a tax-free after-tax benefit. Well, his monthly gross income is $25,000 a month, but after 25% taxes, his monthly take-home's $18,750. He has his group disability benefits. Remember, it was 60% to a $5,000 a month cap. So it's capped at $5,000 a month. But after taxes, he's taking home $3,750. So that's really what his difference is. Your client may think, oh, I've got some group disability, I'm covered. In this case, he takes home just over takes almost $19,000 a month home after tax. If he became disabled, then they're living on less than $4,000 a month. So that same $12,350 a month is what he's eligible for on supplemental individual disability benefits. And it's worth repeating, this is tax-free. So the monthly take-home, $18,750. After factoring in his group disability, he's eligible for $12,350 a month, tax-free. Total, $16,100. And what does that translate to? About 86% of his monthly take-home. So we work this in because many times we think of disability benefits will cover 60% of your income. That's maybe true, but sometimes we're comparing after-tax to pre-tax. What will the disability benefits generally cover when we compare an after-tax to after-tax basis? About anywhere, can be as high as obviously 86%, but it's definitely higher than that 60% when we factor in the after-tax benefits of somebody's income. So we talked about term life insurance and the difference in the group benefits, long-term care insurance, and disability insurance. Lots of different reasons for you and your clients to look at a client's group coverage and ways to find things that are better out there. May not always be better, but like everything in life, it's worth a look. And so, for any of you who I saw at the NAPFA Spring Conference in Salt Lake City, it was good to see you. It was beautiful. It was nice and cool. It's already 90 degrees here in Tampa and humid. So we will be at a number of different conferences, and we're going to be hosting a few webinars later this year. John Hancock and Genworth have recently made some changes to their long-term care insurance policies, and we'll be sending out some information on some of Genworth's changes here in the next day or two. For those of you who are not familiar with us, there are a number of things that make low-load insurance services different, but one of them is the free monthly webinars like you're listening to right now. We're not your competition. Our only clients are field advisors. We do a lot of pre-underwriting to avoid surprises, and we provide tools for you and your clients. We proudly sponsor the new Alliance of Comprehensive Planners, NAPFA, NAPFA Genesis, the Garrett Planning Network, and the XY Planning Network. We have product specialists in life, disability, long-term care, and annuities. When your clients get insurance through us, we keep you in the loop with our AIM system, and we help you and your clients manage their policies now and in the future. I do have a few questions here that I will touch on here. Let me read these here. Can you address the cost difference between group and individual disability policies? Sure. Group either is usually paid for by an employer, so free, so that's good. If a client can, if an employer is providing group disability benefits and the client can either pay for it or pay the taxes on it, it's still generally very inexpensive. Yes, group individual disability benefit premiums are generally very, very low when compared to individual plans. So that's why normally we look at if a client can get as much as they can through their employer in that group plan, then supplement with individual coverage. Some companies will provide, say, 50% as a group benefit, and then the client has the option to buy up an additional 10% with that same company. Those, generally, that extra 10% tends to be priced more like an individual policy and is worth looking at. All right. Some of you are very fast, obviously very fast typers because you can write really, really long questions. One client says, I'm hearing more about alternative or hybrid long-term care policies, life insurance, LTC combinations. Do you provide information on these? And we have more education for advisors on these newer LTC policies. Yes, they are a pretty neat thing that's come about in the insurance world. Either a life insurance with annuities or I'm sorry, long-term care with annuities or long-term care insurance with life insurance. On our website, there is under advisor tools, there are sections about the hybrids, as we call them. And so there's pieces, educational pieces there for you and your clients. They're also the topic of some of our webinars, and so I will reach out to you and see if we have any of those available on our website. Okay, so if the lawyer sells hot dogs, will he get the full 60% of his law earnings if going on claim while a hot dog vendor? Good question. The individual disability policy is underwritten for a monthly benefit based on a client's income when they purchase the policy and their occupation class when they purchase a policy. So, said lawyer turned hot dog vendor, becomes a hot dog vendor, has $10,000 a month, even though he's making almost no money, becomes disabled. He gets run over by the World Series championship fans, and is trampled. Can't work anymore. If he still has that individual policy, then yes. If he's totally disabled, he will still continue to receive the $10,000 a month. Chances are, for most people, wouldn't be able to afford that policy if they were only making $1,000 a month as a hot dog vendor. Not sure how they'd afford the policy. So it sort of worked itself out organically. But to answer the question, it's based on the occupation and income when you get the policy. And at claims time, it's based on, are you disabled at the occupation that you were when you became disabled. All right, well, thank you all very much. It is 5 o'clock, and there are a few other questions that I will email in the next few days. And so, again, thank you all for tuning in. I hope everybody enjoyed it. I hope to see you or hear you or have you type to me next month when we do our next webinar. So thank you, everybody, and have a great day.